Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Rob Arnott, veteran investor and chairman of Research Affiliates. Rob, great to see you. Thanks for joining us.
Thank you for the invitation.
So let's start off maybe by you telling us about Research Affiliates. It's kind of a generic sounding name, but it's a company you've run for a while.
Yeah, we created the business back in 2002, and we're in an unusual part of the asset management business. We're basically an innovation engine. Our job is to identify opportunities to create products that we make available through others. Our two biggest relationships are with PIMCO and Schwab, and there's a host of others, Legal & General, Nomura, BlackRock, and SSGA manage some strategies using our ideas. Our job is to develop strategies, and then we have affiliates, these other companies, that distribute our products. And obviously they don't need us. They have their own product innovation capabilities. So it works if we are creating products that they haven't thought of, that are complementary to their existing product line, and that they believe, as we do, that the products will work. So it's only $140 billion asset manager with no actual assets under management.
And I get the affiliates name now. Okay, so that's good. So what are some examples? I understand that tactical asset allocation is something that you pioneered, but what are some examples of these strategies?
Sure. In tactical asset allocation, we've worked with PIMCO in the all-asset product. That was the first global asset allocation strategy ever to include real assets like TIPS, commodities, REITs, and
TIPS are types of treasuries, right?
Correct. They're inflation-linked bonds. Asset classes that are usually lightly used, diversifying relative to mainstream stocks and bonds, and likely to protect you in an inflationary regime. So that's one example. Fundamental index is an idea that we pioneered back in 2004 that simply says, hey, instead of choosing stocks based on their market cap and then weighting them based on which is the aggregate market value of the company, and then weighting them based on how much they're worth. Why would you do that? That means that you're going to automatically overweight any stock that's overvalued and automatically underweight any stock that's undervalued. Why not simply weight companies according to how big their book of business is? So instead of an index that looks like the stock market, you have an index that looks like the macroeconomy. And it's got this beautiful rebalancing engine so that if a stock soars and its fundamentals don't, RAFI, Research Affiliates Fundamental Index, will say, thanks for that nice gain, I'm going to trim you back. If it tanks and its fundamentals don't, it'll say, thanks for the deep discount, I'm going to top you up. And when the market makes a mistake, jumping on speculation that turns out not to be true, we will have sold and profit from the subsequent drop.
So how has that index that you just described performed against the S&P 500, which is a market cap index?
Sure.
And then the Dow, which is sort of, really problematic in that it's price weighted. Let's just talk about the S&P versus your idea.
Well, think of it this way. If you're taking stocks that are at premium multiples and reweighting them down to their economic footprint, stocks that are at deep discounts and reweighting them up to their economic footprint, you're going to have a stark value tilt. So it looks and feels more like a value index. But unlike value indexes, NVIDIA and Meta and so forth are in there. They're just reweighted down to their economic footprint. Now, if you do that, you're going to have a tailwind when value wins and a headwind when value loses. So what I think is kind of remarkable is this last 15 years has been dreadful for value. This index has beat the value indexes by such a large margin that it's kept pace with the S&P despite a deep value tilt. And against the value indexes over the last 17 years, it's added about 4,000 basis points with no drawdowns larger than 3%.
Right. So, Rob, what do you make of the Magnificent Seven and NVIDIA, maybe especially right now?
Sure. Bubbles happen for a reason. They happen based on a narrative. And the narrative in the dot-com bubble was the internet will change everything. It'll change how we buy and sell goods and services. It'll change how we communicate with one another, how we socially interact, how we try to find information and get our news. 100% correct. The narrative went on to say these companies are the dominant players in the internet, and they will be the dominant players in 5 years, 10 years, 20 years. Not as true. These companies, being dominant players, will be tough to take on. Not entirely true. Disruptors come along to disrupt the disruptors. The narrative was, this will change everything, it'll change it surprisingly fast. No, it changed it gradually. So the narrative today is AI will change everything. How you do your job, computer will do it. How I do my job, computer will do it. It will change how we develop business strategies, how we think about the world around us. And on one level, that's all true. But on another level, it's going to take years and years for it to make all those changes. And it'll be gradual, and disruptors get disrupted. NVIDIA is a terrific company with terrific product. It has a profit margin north of 50%. How sustainable is that? It has a moat. It's hard to build the capability of creating super chips. But AMD has recently come out with a chip that they claim is 25% faster than NVIDIA's fastest, and it's priced 60% cheaper. All right, let's say that's true. Then that means NVIDIA's market share goes down. There becomes a bit of a price war. So the narrative surrounding NVIDIA is they've got a moat, tough to take them on. Their chips are amazing. AI is amazing. They are the heartbeat of AI. All true. But do disruptors get disrupted? Do their profit margins stay north of 50% forever? Do they grow at 50 or 100% per year compounded? No. If you soften any of those assumptions, then NVIDIA turns out not to be sensibly priced, but in fact to be extravagantly overpriced, much as Cisco was back in the year 2000. Cisco's grown handily since 2000. Qualcomm's profits have grown 60-fold in 24 years. And yet Qualcomm's return has been half that of the S&P.
If you take that starting point.
If you take that starting point.
Right. I want to ask you about indexing versus active investing.
Yes.
Passive versus active. And I know you're obviously in the business of passive investing. Well, you do both. Okay. So my question is, there's been such an explosion in passive.
Yeah.
In dollar terms at the expense of active.
Yes.
And there's there are questions about what happens if there's too much indexing, and will that warp the markets in some way we don't understand?
Yeah. Well, firstly, conventional cap-weighted indexing has its own rather significant flaws, and we can come back to that. But once again, the narrative is, this gets back to Bill Sharp's Arithmetic of Active Management, which was a famous article he wrote a little over 30 years ago. The market is cap-weighted. The indexes are cap-weighted representatives of the market that span most of the market. So if you split the world into active and passive, the passive own the index funds, the active own everything else, the passive index funds match the market. Therefore, what's left matches the market, meaning that active managers collectively have exactly the same returns as the index funds collectively, minus fees, minus trading costs. So they must have lower performance with higher turnover. And that logic is unassailable with a couple of important exceptions. One, the index funds don't span the full market. Index funds are not truly 100% passive. And Two, the index funds do push up the market valuation of companies in the index. There was a glitch at S&P in one of their minor indexes a week or two ago. And that glitch caused the stock to rise about 8% because the indexers had to buy it. And then they said, oops, doesn't qualify for the index. It's not really in the index. And they had to sell it. So it popped about 6 or 8% and dropped about 6 or 8%. That price differential means also a return differential, because if you pay more for something, you're going to get a lower future return. So the fact that the indexes don't span the full market means that the active managers still have a role to play. But here's where it gets interesting. If you're invested in an active strategy, the way the active strategy wins is if there's a loser on the other side of their trades. That loser typically won't be the index funds. It'll be another active manager, which means that active management is very sensible, very useful if you can identify the managers who have an edge. And one question, I've been in the business a long time, and one question I've never had in a finals presentation to a client is, who's the loser on the other side of your trade and why are they willing to lose? If you can't answer that question, you probably don't have an edge. It's like the poker analogy. If you can't figure out who the loser is at the table, you're it. And same thing applies to active management. Now, another observation, and that is there have been articles written that equate indexing to socialism because it doesn't do anything relating to...
I've never seen that, but I've seen it criticized, but that's a new one. But go ahead.
Yeah. There is no price discovery.
Right.
There is no effort to determine where capital should be allocated. And that's absolutely true. But you can't dismiss it just because it's quasi-socialist in the way it operates. You have to have something better in order to justify attacking it. And that's where it gets interesting.
Rob, let me shift gears and ask you a little bit about the economy and what your take is on the Federal Reserve. I know you've been critical. Whether we need rate cuts this year, what do you think?
Well, firstly, think about the purpose of interest rates. It's a reward for deferring consumption.
Let me wrap my brain around that. Okay, go ahead.
Now, a reward for deferring consumption should be positive. Interest rates should be positive. Should be positive in real terms. Real interest rates should be positive. Should be positively sloping. The reward for deferring consumption 30 years should be more than the reward for deferring consumption 30 days. So the natural environment is one of positive real rates across the full spectrum and a positively sloping yield curve. Anything that warps that is an artificial distortion that is likely to do more damage to the economy long term than good. What does that mean today? Well, for starters, the long rate is set by the market. It's set by supply and demand. It's not set by central authorities, except in places with yield curve control like Japan. So the Fed says they're data dependent. One data point that they spend very little time looking at is the long yield. If you look at the long yield, 4.25, give or take, the market is basically saying that's going to be enough above inflation to be an adequate reward for 10 to 30-year deferral of consumption. Then the short rate ought to be less than that, ought to be in the 3.25% to 4% range. So I think the Fed ought to cut rates, not because it needs to stimulate the economy. Stimulus is artificial. It's a little bit like giving somebody on the gurney in a hospital a little adrenaline. It might get their heart pumping a little more vigorously, but withdrawing the adrenaline has its own consequences. So Australia's been called the lucky country because it went 30 years without a recession. For most of that 30 years, the first 25 years of that 30 years, it had a short rate that was almost always 50 or 100 basis points below the long bond yield. So I think recessions are unnecessary. I think Fed efforts to manage the economy, to tighten, to reduce consumption, to impose pain, or to stimulate, are deeply misguided. I think a steady hand at the tiller, keeping short rates a little below long rates, is as good as central bank can do. I think it's fascinating. The U.S. Treasury and the Fed, doesn't matter who's in charge, Republican, Democrat, doesn't matter. The Treasury and the Fed try to predict GDP growth, unemployment, interest rate movements a year or two out, inflation rates. Their prediction record is beyond dismal. Why on earth should we expect people who can't forecast the future to manage our future wisely?
That's a great question, and I do not have an answer for you. I have to tell you that.
Nor do they.
Let me ask you, Rob, talk to us a little bit about your background and how you got to be such a free thinker. I mean, you must have studied math in school, for instance, I bet.
Well, college is a long way back, but I was at UC Santa Barbara. I was their last triple major. They changed their rules so that you couldn't do triple majors. Literally the last semester I was there. But I had a major in applied mathematics, computer science, and economics.
Oh, the big three, yeah.
Yeah, and it was specifically with an eye towards applying scientific method to investing. It seemed to me at the time that investing was done on whims, narratives, and rules of thumb.
This is when you were in college. You had this epiphany.
Yeah. And so I began my career as a computer programmer for an investment management firm. I wrote 2 or 3 articles in places like Financial Analyst Journal and Journal of Portfolio Management, and began managing assets using quantitative methods back in 1979. And so I was a quant before the term quant was coined. One of the things that fascinates me about the quant community is that it has become a data mining community. Scientific method involves starting with a hypothesis and then using the data to test your hypothesis, not starting with the data, running through the data to find whatever seems to work, and then coming up with a story for why it works. And scientific method also, with apologies to Anthony Fauci, involves challenging your own thinking and your own premises. It involves openly embracing different perspectives and different opinions. And so applying scientific method to finance was almost unheard of back in the 70s. And it's been a heck of a ride. It's been a lot of fun. But even to this day, the quant community is a performance-chasing community the same as conventional investors. Why? For the simple reason that if you look back historically and find a model that works, the fact that that model works is the reason you embrace it. But if you don't understand why it works, or if you conjure up the explanation for why it works based on that data, then what if it doesn't work? Standard Momentum was published by Jagadish and Titman in 1993, and for the last 25 years, the return on Standard Momentum has been slightly less than 0 before trading costs. So momentum, one of the most popular and beloved factors out there, Standard Momentum hasn't worked for a quarter century. You won't find factor investors who tell you that.
Rob Arnott, Chairman of Research Affiliates. Thank you so much for your time.
This has been great fun. Thank you.
I'm Andy Sherwer. This is at Barrons. We'll catch you next time.